Hey, what's up guys? Welcome back to DG Capital. If you're new to the channel, I talk all things personal finance, investing, and anything money related. For today's video, we'll be answering the question, why does the stock market go up over time? So, let's dive right in. First, let's talk about the traditional ways of making money. You can either take a salary job or an hourly job where you need to trade in your own time for money. Or you could start your very own business and be your own boss. Or you could put money into a bank account and let it earn interest over time. Those are the traditional ways of making money. The other way of making money is investing it. There are a couple of different ways where we can invest our money. First, you can invest your money into the stock market. Two, you can buy precious metals like gold and silver. Third, you can invest in real estate, such as you can buy a commercial property or a residential property. The fourth way is private equity. If you know a local startup collecting funds to launch their business, you could potentially invest your money with them for a stake in their business. That's private equity. Essentially equity that's not available for the general public market. Now, why should you invest? Well, the whole point of investing is that when you invest in an asset, as the value of that asset goes up over time, so does your net worth. Now notice I didn't say buying a car as part of the investable assets. Although a car is an asset, it's a depreciable asset. What that means is as soon as you buy that car and drive off that parking lot, it starts to depreciate or lose value over time. As a car loses value over time, so does your net worth. It decreases over time. So that's the difference between an appreciable asset and a depreciable asset. For the stock market, let's use the S&P 500 as an example. Now, if you look at this graph, you'll notice it has many up years and many down years. But on average, since inception, the S&P 500 has returned close to 10% throughout this period. Now, it doesn't mean it's going to return 10% every year. It just means in aggregate over that time. On average, it has returned 10% with all the ups and downs. And you'll notice the S&P has had more positive years than negative years, leading to that 10% return over time. There is some truth to that old saying, time in the market is much better than timing the market. Now let's look at another graph of the S&P 500. This one shows how the S&P has increased over time since inception, even with 2 world wars and other major black swan events like the Great Depression, the Great Recession, and everything else. Even with all those major catastrophes, it has still gone up over time. In fact, there's been a study that says that the S&P 500 in any 20-year time span has never lost money. So now that we know the background of the stock market and we've seen how it has gone up over time, let's look at the question why it has gone up over time and what causes it to go up over time. In order to answer that question, we need to first look at how do we establish a relationship with the stock market. You can do that by buying a stock or a share or an ETF or a mutual fund. But let's focus on shares and stocks since ETFs and mutual funds are just basket holding various stocks. When you buy a share or a stock, what it does is that it allows you to become a partial owner of a business. Think of a company like a pie, and the slices of that pie, shares. The more slices a pie has, the more people hold on to that slice of pie. Just like shares, the more shares a company has, the more people can become partial owners of that business. Now remember, the smaller the slices of pie, the more people have access to it. The fewer slices of pie, that means fewer people have access to it. Same thing with a company. So let's say a company has 10 shares outstanding and you own one of those 10 shares. That means each share gives you 10% ownership into the business. What if that very same company, instead of 10 shares, it has issued 100 shares? Now, in this case, each share will only give you 1% share of the business. If we look at Amazon, they have almost 500 million shares outstanding. And because Amazon is a public company, that means you and I can go out and buy a share of Amazon from the stock market. And because Amazon has millions of shares outstanding, that means millions of people and institutions can all own a slice of Amazon. At the time of this recording, one share of Amazon will only set you back $3,200. For that $3,200, congratulations! Now you own 0.0000002% of Amazon. That's a very, very, very small slice of that Amazon pie. Compared to Jeff Bezos, the founder of Amazon, he owns 11.2% of the Amazon pie. So now that we understand what shares are and how it allows us to participate in the stock market, let's look at how owning shares increases our net worth over time. There are a couple of different ways of making money by your share ownership. One is dividends, and if you don't know what dividends are, I made a video on dividends and the link is up top. The other way is when that share price goes up in value over time and you sell that share for more than what you paid for, that leads to capital gains. The third way is something called share buybacks. And that happens when a company buys its own shares in the open market. What that does, it reduces the amount of shares available for the public, making each share more valuable. It's fundamental to understand that as the prices of shares go up, so does the stock market. There is a correlation. So when you hear headlines like Amazon's stock price is tanking or Apple's stock price is dropping and it's dragging the entire market, now you know why. Because of that correlation between stock price and market direction. So when you buy a stock, you are in essence trading your money for the right to that company's future cash flows as a shareholder. Now, I want you guys to really pay attention to this part here because it's going to get a little technical. There is a formula that's used to calculate and predict the value of a share. This concept is known as the discount rate or the discount model. There are other ways of performing a share valuation, but for the purposes of this video, I'm going to focus on the discount model. The concept is that the stock price is equal to all of a company's future cash flows. So let's say you wanted to invest $100 into DG Capital Corp. And this company is expected to grow by 10% next year. So that means your $100 will earn 10% or $10, making your investment worth $110. So let's actually work backwards. That $110 valuation in the future, if we discount that back by 10%, is now worth $100 today. We use the growth rate to go from today's value to a future value, and we use the discount rate to go from that future value to today's value. Growth is forward-looking and discount is backwards-looking. If we revisit that Amazon example, and let's say that Amazon is expected to grow at 10% next year, that would make your $3,200 investment into Amazon worth $3,520 into the future because of that 1 year 10% growth. And that future $3,520 discounted back at 10% is now worth $3,200 today. So that's what I mean by discount rate and the growth rate. That 10% is meant to compensate you for the risk you're willing to take because Amazon doesn't have to grow by 10%. It may or it may not. Compared to the interest rate in your savings account, that 1% or whatever the interest rate is, it's almost guaranteed to happen. So that's why if you compare the interest rate on your savings account is minuscule compared to a potential 10% increase in Amazon. The difference is meant to compensate you for the risk you're willing to take. If something is guaranteed to happen, the yield is a lot lower because it's a safer bet. If something is a higher risk, then you should expect a higher return because of that risk you're willing to take. So that's where the term high risk, high reward comes from. So when you're evaluating a stock, consider your own risk appetite. How much risk are you willing to take for a potential return? More risk, more reward. Less risk, less reward. And it doesn't have to be one-dimensional. You can actually build your portfolio with some higher risk assets, with some lower risk assets, so you have a balanced overall portfolio. So far, we've been using 1 year to calculate the future stock price. But what happens when you expand the number of years we need to take into consideration? How does expanding our future cash flows impact the stock price? So as we just covered, DG Capital Corp is expected to grow by 10%, and therefore we're willing to invest $100 today for $110 in return tomorrow. But what if DG Capital Corp is expected to grow by 10% for the next 10 years? So how much should we pay today in exchange for that 10 years worth of future cash flows? Let's take a look. In order to answer this question, you have to remember that the further out in the future we go, the more risk and the more uncertainty there is, because sure, you can say from some certainty that we can grow by 10%, but how likely is it that any business can grow at that one rate for the next 5, 10, 15, whatever years? There is a formula that we can actually use to quantify that risk and that level of uncertainty when it comes to future cash flows. The formula goes something like this. The share price is equal to the cash flow divided by 1 plus the discount rate to the power of T, where T stands for the number of future cash flows we expect. So let's run a discounted cash flow example so you guys can get a better understanding of what this looks like. Let's take a look. In year 1, I'm discounting back the $10 of earnings to today, which is worth $9.09. The second year of that $10 cash flow is actually worth $8.26 today. And if we do this exercise using the formula that I mentioned, at the end of 10 years, the series of discounted cash flows is worth $61.45 today. So we should be willing to pay $61.45 today in exchange for a company making $10 a year for the next 10 years. So for companies like Amazon, who have consistently been able to expand their business and also expand their future cash flows, that's why we've seen their share price skyrocket to $3,200 today because of that expansion, and they continue to expand. So in theory, as long as they continue to expand their business, their future cash flows will also expand, meaning that share price today of $3,200 should continue to go up. But keep in mind that nothing is guaranteed. Amazon may not be able to expand their business, and that future series of cash flow, maybe one of their business has a potential flaw, so they end up contracting, which then decreases that expectation of future cash flows, which will then drop the stock price. So that stock price is just a snapshot at a point of time based on the expectation of those future cash flows. As those expectations go up or go down, so will the stock price. The S&P 500, which is a collection of some of the largest companies in the US, they are all focused on growing their business. So when those expectations of business growth are increased, so does the S&P go up. And when those expectations of future cash flows decrease, then the S&P 500 drops. So you can see how expectation will increase or decrease the S&P 500. Again, it all comes down to our own expectations and the market's expectation of future cash flows. And here's the real cool thing about the S&P 500. The index is self-cleansing, because as companies rise and grow, they go higher up in the S&P 500. And when companies contract, they lose business, they continue to fall down the index until eventually they get replaced by newer rising stars. If you were to go back in time and look at the companies in the S&P 500 and compare that to today, there's a stark difference, because the ones that grew kept on growing, and the ones that couldn't keep up, or the ones that slowed down their growth, dropped to get replaced by faster growing companies. So that's what I mean by self-cleansing. When you own an index fund or an ETF that tracks the S&P 500, you can rest assured that you will own some of the best 500 companies America has to offer. That self-cleansing nature will continuously push the S&P higher and higher and higher to new all-time highs. Wow, I don't know about you guys, but that was a lot of information to take in. So let's summarize what we just covered. The stock market should go up over time because as we humans continue to push the boundaries of innovation, discover new technologies, make new scientific breakthroughs, all that increases our expectation of future cash flows, and as we covered, that expectation will push stock prices higher, and so too will the stock market. So as a whole, when society becomes more productive and new businesses flourish, that will also push the stock market higher. Again, coming down to expectations of future cash flows. If you believe that mankind will continue to prosper, continue to innovate, continue to expand, then yes, you should invest in the stock market to benefit from that long-term capital appreciation. And all you have to do is look back in time how humans have continued to develop, continue to push new boundaries, break barriers, build new businesses, discover new industries. You have nothing but upside to bank on and give yourself the ability to benefit from this growth as a long-term investor. And if you enjoyed this video, please hit that subscribe button and smash that like button so I can continue producing content like this. And drop your comments and let me know your thoughts about where the stock market is headed. Are you optimistic or are you pessimistic or are you sort of somewhere in between? Let me know in the comments below. And I'll talk to you guys in the next one.